Should I rent or should I buy? Now, this topic is often discussed in two contexts. Either the simple one, which is, do I rent the place I live or do I buy the place where I live? Or the slightly more complicated one, which is, do I rent where I live and purchase an investment property? For today's video, I'm going to focus simply on the pros and cons of renting versus buying. I'll run the numbers to help you understand this very important real estate investment decision. My name is Matthew, and on my channel I like to talk about helping you grow your career, income and investments. So if that's something you would like to do, then please subscribe to the channel and leave a like on the video if you get value from it. So let's start with a few quick real estate basics. Now, the basics of renting. You're paying somebody else to live in their house. This is what we commonly refer to as a landlord. The rent that you pay usually goes up by a percentage every year. The person you rent from is an investor focused on return on investment. They've bought this property as an investment property because they're renting it out to you. So they would aim to make a profit or a return on this investment in the long term. The price you pay for your rent is based on something we call a yield, which is usually the percentage of the purchase price. So based on the market or the country, that's a percentage of the market price, somewhere between sort of 3 to 5%. And that's what actually dictates the market rentals that you pay. The risk attached to the working order of the house is entirely the landlord's. So if something breaks or needs to be replaced, like the geyser bursts, then that's the landlord's responsibility and cost, not yours. But built into your rent cost is obviously a premium for the fact that the landlord knows that this is his or her risk to take. Entry barriers to rent are low. You usually need a deposit and proof of income, and that's it. No lump sum cash requirements or anything else. So it is very, very common. Probably more people rent than buy. You can say that generally quite safely. So conversely, buying a house, you go into a deal with a financial institution like a bank, and they will, in exchange for you honoring the terms of a mortgage, give you the property. So for all intents and purposes, it belongs to the bank until you've paid it off, but you enjoy the rights and the capital appreciation attached to the asset from day one. The interest is the risk premium that the bank attaches to the deal that they've made with you, and the house itself is the security on the loan. It's what we would call the collateral or secured lending. And as a result of that, interest on mortgage loans are far, far lower than interest on cars or credit cards, etc., because it's secured, and it's generally secured on an asset that appreciates in value over time. This capital appreciation is actually also what makes real estate investing attractive, particularly in the long term. However, the risk and ownership costs of the property, if you buy, are entirely yours. So if something breaks or something needs to be replaced or something needs to be repaired, generally houses need to be maintained, this is all on you. This is now going to come out of your pocket. Also, though, very important to note is that the reward attached to the property, i.e. the financial appreciation or the value increase every year, is yours to enjoy from day one. So you put down a deposit, let's say for example 10 or 15% of the value, but you can enjoy a percentage increase in the value on the full value of the asset from day one. And this is what we call financial leveraging. This is a very, very important real estate investment topic and a financial literacy topic that you need to understand, because it is a cornerstone of why real estate investing tends to be so attractive and so many people do it. So to get into purchasing a home, you usually need a lump sum of cash, right? So this is the initial equity that the bank requires to underwrite the loan. So it's usually somewhere between 5 to 20% of the purchase price you need to be able to put up as cash. This is probably the biggest challenge and entry barrier in buying a home, but this is what opens the door. So there are more entry barriers. Renting, you can just have a monthly income. You don't need a lump sum of cash, with the exception of 1 month's rent as a deposit maybe. But for purchasing a house, you sometimes need up to a year, year and a half, even 2 years salary to be able to put down to enter into the housing market. To get that right, you're going to need good financial literacy habits like sitting in a budget, investing money, saving money. You also need a good credit score. So as you can see, it's not as easy as renting a home. It is tricky, particularly for first-time buyers. However, once you're in and you're going, what happens is over time, you start to pay off what we call the principal of the loan. So every monthly installment that you pay, a component of it is interest, which is the bank's profit for going into the agreement with you. And then there's the principal, which is the sum that they've lent you that you're paying off. Over time, you pay into the loan more and more, the principal sum comes down and therefore your equity increases. And this term equity is very, very important. It is a fundamental to real estate investing that is very, very critical, and that's why I'm just flagging it here. Building equity in your mortgage is a key thing to solving the money problem, because over time it gives you so many financial options. With that high-level introduction and just a brief explanation of renting and buying as concepts, let's climb into example to run the numbers and see how it works. So here I've jumped into my computer and I want to try and contrast a very, very simple example of rent versus buy and see what the better option is from a financial perspective. Now, there's a couple of terminologies here that we need to go through. I've already mentioned most of them, but we're just going to focus on this area of the sheet for now, just to introduce the concept at a pretty straightforward level. So we're going to use a purchase price / house value of $1 million example dollars. And what we're going to assume is you're either going to live in a house of that value and rent it, or you're going to buy it. Okay, just to keep it simple. So we're comparing apples with apples. Now, my friend Google told me that on average a rental yield is somewhere between 4.5% to 6%, depending on where in the world you are. So I'm just using 5% to determine what my monthly rent cost will be. I'm using inflation as the annual rent cost increase. Usually it's a little bit above inflation. I'm also using, for the buy option, inflation for the house appreciation per annum, and that also generally tends to be a little bit above inflation, particularly in sort of inner city areas and affluent growing areas, etc. But to keep it simple, we'll keep those variables the same. For our buy option, we'll use a bond interest rate of 4% and we'll use a fixed interest rate. So you can get two types of home loans. You can get a variable interest rate, which is attached to the prime lending rate, or you can get a fixed interest rate. For this example, we'll just use a fixed interest rate to keep it simple. The deposit sum required we'll use is 15% of the purchase price. So you can see $150,000. And we're going to use a bond term of 25 years. Okay, so that's just a high level comparison to see what is going to flow out of the pocket in the two options. All right, and this is where we jump over here. So I cheated a little bit and I pulled the Graham Stephan, and I used a calculator that you can grab off the internet. So you just punch in a couple of variables and then it calculates the answers for you. I'm just playing. I think it's probably a very efficient way to do things. But I just did that to calculate the monthly installment on the $850,000 mortgage loan. So that's how I got this number here. And then I've simply multiplied it out by 12. The reason why your mortgage installment is fixed for the duration of the loan is that the bank uses what we call present value discounting. So they take the entire loan, they project what it's worth in the future plus interest, and they bring it back to the present value and divide it by the total number of years. So that's why it doesn't go up every month or every year, because they factored in the entire duration into the calculation and to arrive at a flat payment from day one right until the end, which means that over time the loan actually becomes more affordable because it doesn't increase with inflation. And that's important. We'll go into a little bit more detail on that now. So we've got our annual bond, and we're going to compare that to our annual rent. So the annual rent, I've simply gone and taken the $1 million and I multiplied it by the yield of 5%. And you can see that's what the rent is going to cost us. And every year the rent is just going to go up 3%. And that's all that's going to happen on the rent track. There's nothing more complicated, there's no hidden costs, there's nothing more additional that you're going to pay. This column is called annual own. And the reason for that is over and above the bond, I also have other costs. I have what you would call ownership costs. This is generally linked to things like the insurance, property taxes. In some countries, if you don't put up a sufficient deposit, then you also need to pay insurance on your loan, your mortgage loan. So I've added a cost factor here every year for what you need to basically pay to own the house. This is everything included, so your insurance, your rates, and your repairs. And you'll see I factored in something major every 5 years. So you replace a geyser, or you replace a roof, or you do some sort of major renovations. As a house gets older, naturally it requires more work and more things to be spent on it, more things to be replaced. This is obviously your burden as the owner of the land or of the property. Okay, so you can see I've put in big things here. You're going to spend $25,000 in year 15 because you've got to do something major. In year 20 again. So I've really been quite conservative and tried to bump up and be very sort of worst case scenario in terms of what you're going to spend to own this property, so that I can get two comparable columns, which is these two here. So the cost of annual rent versus the cost of annual ownership. And you can see that at year 9, for the first time, rent overtakes ownership. It's important to understand that in the short term, if you're going to buy a house and then you're going to sell it in 3 years, or 5 years, or 7 years, or 10 years, you're going to break even / make a loss, because you're going to start over again if you then buy another house, and you're not going to realize the profits of your capital appreciation and the other benefits of holding a property long term. So it's very obvious from this that in the short term, renting is cheaper. But I'll show you as we progress over the years, ownership comes out far, far ahead, but it does require a significant amount of time for that to materialize. So let's illustrate that down here. So now what we're moving towards is the fact that when you buy this house, it appreciates at its full value from year 1. So you can see the value of the house is going up year on year on year on year by 3%. All right. Now, assuming I don't buy the house, the amount that I'm not spending on my mortgage loan initially is my excess cash. So if I invested the deposit that I didn't make on the house and my excess cash and what I paid the conveyor, which is something I left out earlier. So obviously you need to pay what is like a mortgage underwriting, stamp duty, transfer duties. They've got different terms in different countries. But when you buy a house, this is basically a government tax that you need to pay. So your deposit plus your government tax are your upfront costs. Now if you don't buy a house, then this is cash that you don't need to spend, and therefore you can invest it. So that's the column that I've created here, which is showing that instead of buying the house, I'm going to invest this deposit and conveyor cost, and it's going to grow over time. All right. So what we then see is a graphical summary of the two options. So on this graph here, you've got the costs of renting. You can just see that it goes up on a flat line continuously for 25 years. Then on this graph here, you can see ownership costs are a bit sporadic. So the mortgage is flat, but these spikes are the every 5 years expenses that I need to spend. But you can see over the long term, I'm going to spend more money renting than I am buying, because the cost goes up year on year on year all the time. What I'm not getting as a renter is this appreciation, where my asset is moving from a value of $1 million to $2 million. So if I roll all this up into a summary to try and contrast the value between two options, what I need to do is I need to look at the rent outflow, in other words, the money that goes out of my bank to rent this house for 25 years. And I need to compare that to the buy outflow, which is the money that went out of my bank to pay for the mortgage installment every month, plus the ownership costs, repairs and maintenance, etc. Now, in my buy option, I have an asset that is worth $2.1 million. I don't have that in my rent option. I do have an investment principal that has grown. So if I look at my rent option, I need to take the rent outflow and I need to add the value of my investments that I made because I didn't buy the house to it, to make it comparable and to be fair. All right? So I arrive at a net cost of minus $584,000 over 25 years to rent this house, compared to a net profit of $362,000 to buy the house. So if I compare the two options, buying over the long term is worth $1 million more to me, comparably speaking, and therefore, from a financial perspective, a far better option. Additional considerations is at year 26, I've now paid the house off. I no longer have a monthly mortgage that I need to pay. I've only got my maintenance and my ownership costs. Whereas in my rent option in year 26, I've still got to keep paying rent every month and it's still going to keep going up every year. So this is a further argument in favor of the buy option. Also, in some countries, the interest on your mortgage is tax deductible, which will increase your take-home or your after-tax salary, which is another argument in favor of buying versus renting. The only proviso that I would say here, please don't buy an old dilapidated piece of rubbish house that's requiring huge amounts of sums to repair, maintain, and fix, because that's going to eat away your profits. And if you're buying with the intention of selling and buying again and selling and buying again, all those profits are going to be eroded by the costs of commissions, buying, selling, and all of the costs that go into registering new mortgages, etc., etc. So this profit is realized if it is your forever house, i.e. the house that you buy and you're planning to settle down into for the long term. All right, so as you can see, the money or the financial arguments stack up that buying is a far better option than renting. I think there's some more arguments that can be made for buying, or more considerations that you need to make when making this decision. The first one is, right now in the pandemic, interest rates are at an all-time low. Banks are desperate to underwrite new mortgages, and it's because this is such a huge revenue stream in the financial services sector. So, into like where I live here in Australia, mortgages are being offered at 3%, which is 1.5% lower than what they were just a year ago, because banks are trying to turn over mortgages. So the entry barriers are a little bit lower than what they would usually be. And I reckon you'll probably find this across the board as businesses are struggling and they need to try, and people need to be buying homes. So that is a very, very important consideration. So if you can scratch the cash together to enter the housing market, now would be a very, very good time to do so. The second argument in favor of buying, no landlords. Okay, landlords can be a huge pain. Here's a picture of my wall, my house. I rent at the moment because I've recently immigrated and therefore I've only been in the country for less than a year. So I still want to figure out where I want to live and settle down. So I'm just renting temporarily. And I have a reliance on my landlord to fix this wall, and he's decided that these planks are a super safe and sustainable solution to this. So landlords do come with some challenges for sure. When you own a house, you can paint where you want, when you want to. You can modify where you want to. You can put anything in your home that you want to. You've got far less limitations. You don't need to get permission to do things. It is your home. You can nest, you can make it your own. When you rent, there's always this reluctance to nest and make it your home. And I think that's another argument or another reason to really consider buying if you can. I think probably one of the biggest arguments in favor of buying versus renting is nobody can tell you to move. You won't be broached with when your lease is coming to an end or it's about to expire saying, yeah, you know what, we've actually sold the house, you guys need to get out of here. Or, you know what, we don't like you as a landlord or as a tenant, so you need to go. Or, we've decided we're going to move back into the house because we're not happy where we are, so you need to go. And that's always the risk of renting, is you are at the mercy of whether somebody actually wants to allow you to live in their house. Another reason why I'm a huge fan of buying is it forces you to invest in yourself. You don't have a choice. If you need to build up a 15 to 20% deposit, you're going to have to start to learn on a budget. You're going to have to start saving money. You're going to have to start investing money. You're going to have to start improving your financial literacy. You're going to have to understand real estate and real estate investing, because it is difficult to enter the housing market. And therefore it forces you to understand personal finance, and it forces you to put the discipline in place. And when you do own the house, you have to pay towards your equity, because you owe the bank the interest and the principal portion every month. And if you don't pay it, you can't keep living in your house. So it almost locks in your value as an individual by getting yourself a mortgage. So it's got a lot of hidden benefits. And that's why I'm a really big proponent of buy versus rent. And when you build equity in a mortgage, things become cheaper. Because if you've got a mortgage that you've had for 10 years and you want to buy yourself a $50,000 car, you can get an access bond and you can take the money out of your bond and you can pay for the car cash. And then you finance that additional $50,000 at the same rate that you would have been paying, sort of 3-4%, instead of paying 7, 8, 9% on a car loan. So you've got more flexibility in your financing options, and you can finance things or new assets for a lot less cost. And over time, because a mortgage is a fixed monthly installment, as your income starts to grow faster than your monthly costs, you'll probably be able to pay more than your minimum monthly installment on your mortgage, and therefore you'll be able to pay your mortgage down sooner. Now, I do understand that there are some circumstances where renting makes sense. I rent at the moment, and because of my personal circumstances, I've just moved to a new country, and I need to figure out a few things in terms of where I want to stay, what's a good area, before we make this decision. So, if you are in a scenario where you don't know where you're going to be long term because of your job, or you're traveling a lot, or you just have a little bit of not instability in a bad sense, but just unpredictability. And you want to be able to keep that flexibility in your life. You want to be able to keep those doors open. Then renting in the short term makes sense. The other advantage that renters have at the moment is that it's a bit of a renter's market. So with people being under pressure financially because of the pandemic, landlords are not going to be able to ask for the types of increases that they are used to. So if you are renting, my advice to you would be try to leverage moving out, because I think landlords don't fancy the idea of getting new tenants, particularly now. So try to leverage the idea of moving out in exchange for a very low or even no increase on your rent if you renew for another 1 to 2 years, because this will obviously cut down the downside of renting, which is that increased annual cost that we spoke about earlier. If you're renting, it's important to remember that the only way you're going to get on the road to being able to buy one day is to set up your budget, is to pay yourself first, is to save money, is to invest money. So please, even if you need to rent in the short term, always have your eye on the requirement to build this deposit so that you can enter the housing market sooner rather than later. I hope you enjoyed today's video. If you did, please hit the like button if you got value from it, and subscribe to the channel. Next week, I'm going to talk about the merits of buying an investment property while you're still renting the place that you live. Until then, stay safe, and thanks for watching.